Hello guys, welcome back. Happy new month. Welcome back to our February edition of the Expert Spotlight series. Okay, did you miss us at all? I mean, how was the January edition? I'm sure it was the bomb. It was the bomb. Okay, we're back again this February and we have 4 professionals coming to train us this month. So for today, we have Ridwan Opaleye on the call with us, and he's going to be talking to us about ABC of budgeting. So you see, anything you want to know about budgeting, just stay on the call, get your pen, get your jotter, and you're going to learn, right? Ridwan Opaleye is a very smart person. He's a friend that I got through LinkedIn, and he's been really amazing. He's also a first class graduate from Federal University of Agriculture. He works as an accounts manager at VP Group of Companies right now, and he's really sound. Guys, trust me, he's really sound. So guys, let's get right into the tutorial. How are you doing today, Mr. Ridwan?
I'm doing great, Perpetua. Good evening.
Good evening. Good to
have you. How has been your weekend?
Not bad. We're pushing. Okay, before we delve into the tutorial, before I give you the mic, I just wanted to ask like a bit of question. I know you currently work in the manufacturing space.
Yes, very well.
So I just want to ask, what has been your greatest challenge working as an accountant in the manufacturing space? And what advice do you have to like other people that are thinking of joining that sector, other accountants that are thinking of joining that sector? What are the few advice and tips that you have for them?
Thank you very much, Perpetua. Actually, working in a manufacturing sector has been an eye-opener for me.
Okay.
The major challenge people have with working in the manufacturing sector, especially as an accountant, is the lack of understanding of the business process.
Okay.
Before you can work as an accountant in a manufacturing setting, the first thing you have to do is to understand their business process. So you have to collaborate with different departments like the production department, the procurement, the quality control, and all other departments within the organization. Because you'll be dealing with them on a daily basis. So if you don't really understand the business process, I think you are on your own.
Okay, so in summary, what you're saying is that if you really want to excel as an accountant in a manufacturing space, you need to take out time to understand the business process.
100%.
Okay, that's cool. Thank you very much for your right, Mr. Ridwan. Please, you are teaching us on ABC of budgeting today, and you have the floor. Please, you can go ahead with the tutorial. Thank you.
Thank you so much, Perpetua, for organizing this program.
Thank you as well. Thank you for honoring our invite.
Last week I was able to watch the chat with Iwelabi. And I really enjoyed it. Same as that of Oyindamola.
Thank you.
So, well done for a good job.
Thank you so much.
Good afternoon, everyone.
Good afternoon.
Like she has said, my name remains Ridwan. So today we are going to be looking at the ABC of budgeting.
Okay.
Perpetua.
Yeah.
Have you in one way or the other find yourself where you tell people I have a budget when they tell you to give them something like money and you tell them I have a budget?
Okay, yeah, of course. I don't know about other people, but I feel like, I don't know if it's because I'm an accountant, but I always have a budget every month. So sometimes when you come to me like mid-month or towards the end of the month and maybe that expense is outside my budget and I say I have a budget, they will look at me like, what do you mean by you have a budget? Come on, don't spend this money. Yes, so yeah, I do that. I actually have a budget.
Okay, that's good. It means I'm not the only one in that shoes.
No, you're not. Maybe it's an accounting thing. An accountant thing.
Yes, they believe we are stingy.
But it's not being stingy.
But we are just prudent.
Exactly.
We are accountable for everything.
Exactly.
So if someone like Perpetua and I can have a budget on a monthly basis, why won't an organization as big as a manufacturing company have a budget? So it shows how important our budget and budgeting is for individuals as well as for organizations.
Yeah, you're right. You're right.
So today we'll be looking at the ABC of budgeting.
Okay.
So let me move to my next slide. So let me briefly tell you the content of this presentation.
Okay.
So the first item on the agenda is looking at the difference between budget and budgeting.
Okay.
Because sometimes people get it twisted. They believe budget and budgeting are the same thing.
Okay.
And the next, we are going to be looking at benefit or purpose of having a budget or benefit of budgeting in an organization. So followed by the types of budgets.
Yeah.
Look at different type of budget, like 3 types of budgets.
Okay.
So also, for a budget to be successful, there are some important factors that must be in place, which are a great determinant of the success of the whole budgeting process.
Yeah.
So we'll also be looking at that.
Okay.
So fast forward, we'll be looking at the budgeting generally in the manufacturing setting.
Okay.
Probably in future lectures, we'll be looking at other industry. But today we'll be looking at the manufacturing industry.
Okay, that's fantastic.
Yes. So next, we'll be looking at the stages involved in preparing budget for a manufacturing company.
Okay.
So followed by different types of budgets. We'll be looking at the sales demand budget, the production budget, the material budget, the direct labor budget, the cash budget, and finally the variance analysis.
Okay.
Because if you are budgeting and you are not carrying out a variance analysis, it's as if you are not doing anything.
Exactly.
You have to compare your budget with your actual performance.
Yeah.
So that is when you know whether you are doing fine or you are doing badly as an organization. So now we'll be looking at the difference between a budget and budgeting. Actually, budgets, people say budget, people use budget every time.
Yeah.
People also say budgeting. Budgeting itself, it's a process of preparing a budget.
Okay.
When an organization comes up with a budget, the process of coming up with that budget is what is called the budgeting.
Okay.
So in simple terms, budgeting is the process of preparing a budget. Why budget? We can say a budget is a plan, a financial plan of an organization for a particular period, usually a year, stated in monetary terms.
Okay.
So we can see budget as a document, why budgeting is the process of preparing that document.
Okay.
So I think with that, we now understand what budget and budgeting is. So what are now the advantage or the purpose or the benefits of having a budget or preparing a budget?
Yeah.
In most cases, when you look at organization, they always have a long-term plan.
Yes.
Let's say 5 years and 10 years, between 5 and 10 years. So when they have a long-term plan, they also have to have a way in breaking them into short-term plans, like annual plan, monthly plan, daily plan.
Yeah.
So, for instance, an organization that wants to be a market leader, that want to have like a 70% of the market share in a particular sector in 5 years' time. So, in order to achieve that goal of the organization, they have to come up with what is known as a yearly plan.
Okay.
Which is where our budget comes in. So a budget is used for converting long-term plan into detailed short-term plan. That is an annual plan.
Okay.
So that is the most important purpose of having a budget. So when the top management sets the goals and objective of organization, so for 5 years, for 10 years, so you have to translate it into an annual plan, which must be sent to individual managers.
Okay, so I have a question.
Okay.
So from what you said now, what I understand is that you're saying that when an organization have like a 5-year or 10-year plan, we probably have to break it down into annual, which is called the budget, right? So my question is, but there are times that you see a company prepare like a 5-year budget, 10-year budget.
Okay.
Is that not still a budget? Because it's kind of confusing or contradictory. That's the right word to use. Can you clarify that? Does it mean that a budget has to just to be for 1 year, or is it possible for us to have budget of like 5 years, 6 years, 10 years?
Actually, you can have a budget of 5 to 10 years.
Okay.
But even if we have 5 to 10 years, you can't reach that level at once. It means that you still need to break it down into an annual plan.
Okay.
So to know whether you are deviating from your long-term plan or not.
Okay.
So I said another purpose of a budget is to communicate organizational plan to managers and other employees.
Okay.
So the budget has been prepared and approved by the top management. That is the people at the strategic level within an organization. So it still needs to be communicated to other levels, like the operational levels and the tactical level, the middle and the lower level managers.
Yeah.
So budget is a way of communicating those plans to line managers and to other employees in achieving the goals of the organization. So another important, a very critical benefit of having a budget is for controlling costs.
Exactly.
It's very, very important. Let's assume I earn 100,000 in a month and I don't have a budget as regard my expenditure for a particular month. It means if anything comes up, whether it's a need or it's a want, so far I have that particular finance, I will just go for it.
Exactly. There's no guide.
There is no budget, there's nothing. So I won't be able to track or control my costs.
Exactly.
So it becomes a problem for me as well as for an organization that doesn't have a budget. It's like you want to build a house and you don't have a solid foundation. As if you are doing nothing.
Yeah, exactly.
So finally, when you have a budget, it's not about just preparing a budget. You still need to measure your performance.
Okay, exactly.
Performance measurements are in terms of you compare your budget with your actual activity. A budget is like an estimate of what you want to achieve.
Yeah.
So it's like a forecast. You want to achieve this thing in 1 year time. And what was the actual result at the end of the year? So when you now compare your budget and your actual performance, that is where you are making use of your variance analysis. So it is a very important benefits of the budget and the budgeting process. So now we'll be moving on to types of budget. Before I go to type of budget, Perpetua, I know you must have heard different approaches to budgeting, like incremental budgeting.
Yeah, zero-based.
Like zero-based, activity-based budgeting.
Yeah.
Yes, value proposition. I think those are the 4 major approaches to budgeting. All having their own advantage and disadvantages.
Exactly.
So let's assume a manufacturing organization that has been in existence for like 5 years.
Yeah.
And they want to plan, they want to prepare a budget for the next financial year. Which of the budget approach will you advise them to use? And what are the reasons for that?
So you said the organization have been in existence for more than 5 years.
5 years.
So first of all, let me start with the first budgeting approach. I would not tell them to use a zero-based budget. Because if they use a zero-based budget, it means that they're starting everything all over again, and that will take a lot of time and manpower, right?
Okay.
Although the advantage of zero-based budget now is the fact that, I mean, if there are mistakes from last year, they would not be able to carry forward because they're starting from afresh. But when we really look at it in the real sense, I mean, some of these things, it's easy for us to say it in paper, right? But if you look at it in real term, you would realize that it's almost impossible for you to carry. It's almost impossible for you to use a zero-based approach, right? So yes, I would not say zero-based approach, budget or whatever it is. The one I would really advise is, I would say maybe like an incremental budget. So the incremental budget is the one where we have a figure for last year, and then we are just reviewing it to cater for inflation, maybe increase in quantity or whatever factors. Whether we might be, I mean, when we say incremental, sometimes it doesn't mean we are increasing. We can even be decreasing. So let's say we had a line item that at the end of, maybe we budgeted 200,000 for telephone, and at the end of the year, the actual cost was maybe 150,000. So when we pick the budget for last year, for this year, we might actually move it down from 200,000 that we budgeted last year to like 180. You understand? Which is very close to the actual. So yes, for me, I would say an incremental budget because it saves time and it's efficient. I mean, that's the answer I have.
Thank you so much, Perpetua.
Yeah, thank
you. Actually, that was what I was expecting.
Okay.
Zero-based budgets can be used basically for.
I passed.
I don't know.
Okay.
So the zero-based budget can actually be used probably for a new company. That is still in their early stages. But once a company is in existence for like 5 years, you know your performance based on last year, previous year, like 2 years ago. So you actually know, at least you can estimate what the next financial year could be like.
Yeah.
So using an incremental budget can be the best bet, although it might also lead to waste.
Exactly.
The disadvantage of using an incremental budget. That is just by the way. So let's come back to the type of budgets we have.
Okay.
We have like 3 major types of budgets. We have an operating budget, we have the capital budget, and we have the cash budget, known as a cash flow budget.
Okay.
So in most manufacturing organizations, they always have an operating budget. Majorly, an operating budget is all about production, the core business activity of an organization.
Okay.
The production budget, the material required budget, the labor budget, and overhead budget. Those are different types of operating budgets. So now we'll be looking at the capital budget, majorly known as capital budgeting, which is not what we are going to be discussing today.
Okay.
So capital budgeting is majorly about, maybe probably you want to acquire a new fixed asset. So that you want to use for day-to-day running of your business.
Yeah.
So those are the major examples of capital budgeting.
Okay.
You can use like project evaluation techniques to check whether a particular project is worthwhile or not before you decide to invest in capital budget. So next we go to our cash flow budget. Cash flow is all about what comes in and what goes out. An organization. Let's assume, what are we expecting from our customers in terms of receivables?
Exactly.
What are we paying to our suppliers in terms of payables? How much are we paying to our employees in terms of salary? So at the end of the day, you'll be looking at whether you have excess of inflow over outflow, or excess of outflow over inflow. Which is a very important topic in accounting.
Exactly. I was even going to add that. I mean, for me personally, I feel like regardless of whatever capital budgeting that you've done or operating budget, I feel like special emphasis should be placed on that cash budget because it can make or mar you. No matter how good your other budget can be, like, and I think one beautiful thing for me about this cash budget is the fact that ahead of time when you'll be cash when there will be cash scarcity in your company. So when you're doing your cash budget, you can predict that by June we would not have enough money to pay salary. So before June, you will start looking for loan or start looking for extra sources where you can get money to fund your expense for that month. So cash budget is actually very, very beautiful if it is done properly. If it is done properly, you will be in a situation where there will never be a problem of liquidity because you can see ahead and you make plans, you put measures in place. Yes, you put measures in place. Yes, so yeah, that's it.
Yeah, thank you so much. Thank you so much.
Thank you.
So before we move to the next slide, we'll be looking at factors that determine the success of a budgeting process. Let's assume you want to achieve a particular objective and you don't have the support of your superior or your manager at work. Do you think you will achieve anything?
I think no matter the effort,
is it going to be easy or difficult for you to achieve that objective?
I feel like no matter the effort that you put into it, it will just be like your effort is being frustrated, right? It will, because if everyone is not fully aligned, no matter what you do, they'll just keep poking holes in it. Like, okay, why is this one like this? Why is that one like that? And before you know it, you get frustrated because you are humans. Yes. So for me, the support of whoever is in charge, your superiors, is even not just your superiors, even the people below you. The superior, the cooperation of everybody is important.
Yes. So it means that the support of the top management is very important when it comes to budgeting.
Exactly.
So they have to give 100% support to the whole budgeting process.
Exactly.
So as well as the motivation of managers and employees. Let's assume you have managers and employees that are not motivated. Towards achieving the goals and objectives of an organization.
Yeah.
It means we are just wasting our time.
Exactly. You know, sometimes there are some companies that when they prepare the budget or when the finance department are done preparing the budget and then they share with every other person involved, it's like a mockery. People are just looking at it and shaking their head because there's no motivation. They're like, people want us to make sales of this amount. Okay, now let's see how it will go now. You know this. So budgeting is actually a very sensitive topic, honestly speaking. It goes beyond putting numbers on papers. Like the right word now.
You have to communicate with
exactly. You need to get it right. You need to get it right. It's beyond putting numbers on paper is the least of your worries when it comes to budgeting. Getting people that will actually support that budget.
The most important.
I am telling you. I am telling you.
So for managers, the most important way you can motivate them to support the whole budgeting process is to seek their inputs.
Exactly.
When you are preparing the budget. So once they know that they have an input in the whole budgeting process, so when you are now sending their budget back to them, they see it as theirs. So
that's like a bottom-up approach, right?
Yes, bottom up. Yes, that's it. That's one of the approach again to budgeting. Top, bottom. So it's very, very important. So I think these are the two key factors.
Yeah.
Although there might be other factors, but I believe these are the two key factors.
Yeah, I agree.
That determine the success of a budgeting process. So let's move to the next slide. We'll be looking at the budgeting in the manufacturing industry. Budgeting in the manufacturing industry. For anybody to prepare the budget of a manufacturing company, they have to have a good knowledge of the business process or a manufacturing industry. You have to know each unit, like each department, and how important are they in the whole budgeting process. So we'll be looking at the principal budget factor. I think the majority of you must have heard about limiting factor.
Yes, days of QA.
Yes, performance management.
Yeah.
So limiting factor is the same thing as the principal budget factor or key budget factor. So there are those things that set limit to what you can achieve in terms of operation.
Yeah.
So let's assume you want to produce 50 bags of a particular unit. And you have limited supply of raw materials.
Yeah.
It means you won't be able to achieve that particular objective or goal due to shortage of raw material.
Okay.
So you have to identify the key limiting factor first. So once you are able to identify it, you will be able to work around it and plan based on the maximum units of that particular limiting factor that you can have.
Okay.
So in a manufacturing company, I think the most principal budget factor is always sales demand. Sales demand. Let's assume this is the beginning, this is the end of the year. Let's assume we are in November and we are planning to prepare the budget for next year. The major thing, especially in operations in a manufacturing setting, the major thing we work on is the sales demand. When you know the quantity of products you'll be able to sell in the next financial year, it helps you to plan for your production, for your material requirements, for labor requirements, overhead requirements, and other expenses. You can easily predict them.
Okay.
So sales demand is a very, very, very important principal budget factor when it comes to preparing budget for a manufacturing company.
Okay.
Although we can have other limiting factors like manpower. Manpower can be a limiting factor. Machine hour too. Let's assume you have an old machine that can only produce 50 units in a day.
Exactly.
And you prepare your budget, you are saying that you want 100 units in a day. It's as if you are just playing.
Exactly.
Just playing. So they set limits to what can be achieved within a particular period. It can also be material. It can be material, manpower, or machine hour. But basically, we are going to be looking at the sales demand as the key limiting factor for manufacturing organization. So before we delve into the practical aspects of this session, we'll be looking at the stages involved in preparing budget for a manufacturing company.
Okay.
Basically, I think it works for other industries too. We can make some little adjustments depending on the limiting factor.
Yeah, I agree.
So the first stage, which is the stage 1, is the communication from the top management or the budget committee.
Okay.
As regards the guidelines for preparing of those budgets to line managers, the top management or budget committee. What is a budget committee? A budget committee are a group of people that develop, they approve, and they monitor the whole budgeting process. They are majorly from different departments like the finance department, they can be from the production department, they can be from the procurement department, they can be from the production planning and control. I think that's one very sensitive department in the manufacturing setting. Production planning and control. It's not that they are not producing, but they monitor the production. They predict a material requirement in advance. So they plan for material requirements for an organization based on the principal budget factor, which is the sales demand. So once you tell them next month we are going to be producing 10,000 units, they work hand in hand with the store department. So they check the availability of raw materials. If they are not available, they request for quotation, they get approval from the top management, and they make sure that those materials are always available for production. So those are basically the duties of production planning and control. Next to the second stage is to identify the principal budget factor, which we have already identified for the manufacturing company, which is its demand.
Okay.
So, Perpetua, the next thing is to prepare the budget for the principal budget factor. Because it is only when you prepare the budget for your sales demand that you can easily prepare other functional budgets. Like the production budget, like the material budget, labor budget, and overhead budget.
Okay.
So after preparing your sales budget, You then prepare your other functional budget, which is the fourth stage. So the next stage is to submit your functional budget to the budget committee for review.
Okay.
Budget committee, one of their duties is to review the functional budgets. They review it. If there is need for amendment, they amend. They ask important questions from individual departments. So the next thing is to prepare your master budget. A master budget is a very comprehensive budget. But in summary, it tells you the profits or loss you are going to get from your operation, like an income, just like an income statement. So it combines all the functional budgets, like the sales budget, production budget, overhead, labor budget, to arrive at expected profit or loss for a particular period.
Okay.
So the next thing is to get the approval of the top management. So the budget committee presents the master budget to the top management and get the approval.
Okay.
So the next thing is to send the approved budget to the line managers, like middle level managers and lower level managers for implementation. And the most important and the most critical stage in the budgeting process is the last stage, which is the control process. If you have a budget and there is no control mechanism, it's as if you are not doing anything. It's as if you don't even have a budget. That's if you don't have a budget. So you have to put in place a mechanism that monitors the performance of that particular budget from time to time. If there's a need for adjustment, there should be a recommendation and you get approval from the necessary persons. So I think those are basically the stages in preparing a budget for a manufacturing company. I think those are like 7 or 8 stages.
Let me count. 1, 2, 3, 4, 5, 6, 8. Yes, 8. Yeah.
So those are the 8 stages in preparing a budget for a manufacturing company.
Okay.
So the next thing we'll now be going to the next and the most important aspect, which is the analysis. So we are going to be presenting the budget for a manufacturing company.
Okay.
So we are going to be looking at the operating budget and the cash budget. So I think the first line item on the operating budget is the sales demand.
Okay.
So we'll be looking at the sales demand. We'll be looking at the production budget. We'll be looking at the material budget and labor budget.
Okay.
We'll be looking at the cash budget.
Okay.
And we'll be looking at the variance analysis.
Okay.
So let's start from the sales demand budget.
Okay.
So I have a company that was just established like 5 years ago. So the name of the company is No Grip for Anybody Nigeria Limited.
Okay.
So they are into manufacturing of plastic chairs.
Okay.
And they make use of only one raw material, which is called HDP, high density polyethylene. So that is their major raw material. That is the only raw material that is used in the production of those plastic chairs.
Yeah.
So they have a marketing team. So after carrying out their marketing research and other things and forecast from last period, which was 2022, they came up with the following data. So they said that the expected sales volume in 2023 is going to be 15,000 units of plastic chairs. So, and the next thing is that they also said that they will be able to sell each chair at the rate of 200 naira per unit.
Okay.
So that is basically their forecast, upon which the sales budget was prepared. So we now be going to our Excel spreadsheet. So we'll be looking at, can you see my screen?
Yes, I can. But it's still showing the PowerPoint. I can't see the Excel.
Okay.
I think you're only sharing the PowerPoint. You might need to share your entire
Okay, let me share the Excel
window. Yeah. Okay. Stop sharing and share again.
Okay. Okay. Okay, stop share. Okay. Okay.
Then share again.
Here.
Yes, when you're sharing now, they'll give you the option to you pick window.
PowerPoint.
Okay. You can just pick your window so you can switch between PowerPoint and Excel.
Okay.
Okay. Here we go.
Okay, I think this is PowerPoint. We are good to go.
Yeah.
So we'll be looking at the operating budget and the cash budget. So this is the table of contents. The first item here is the sales budget, which is the principal budget factor on which we are going to be based our analysis on, because there is always a link between the principal budget factor and other functional budgets. So most of the data we are going to use to prepare our other functional budgets are always from the sales budget. So let's go to our next sheet, which is our operating budget.
Okay.
So can you see my screen?
Yes, I can.
So we have the sales budget rule here. So the name of the company is No Gree for Anybody Nigeria Limited. Financial year 2023.
Okay.
So the budget is for January to December 2023. That's 1 year budget. So you can see that we have the sales budget, we have the production budget, we have the material budget, and we have the direct labor budget.
Okay.
So for us to get our sales revenue in a particular period, I believe we have to multiply our sales price or our selling price by the sales volume for a particular period to get our total revenue for a particular period.
Say that again. Sorry.
I said for us to arrive at our total sales revenue for a particular period, we have to know our selling price and our sales volume for a particular period.
Oh, definitely, yeah. Okay.
So basically, we can have more than a product.
Okay.
We can have one product, you can have two products, you can have three products.
So we list out all our products. Okay.
So like here we have the sales volume, we have product name, product 1, which is P1, product 2, which is P2, product 3, P3. So if you have as many as 10 products, so you can have each row for each product. So there's another line for your price per unit. You also need your price per unit. And the next one is your revenue. Your sales revenue is your volume multiplied by your selling price, which is your price per unit. So back to our question.
Okay. So the sales budget now, basically, to get the information on that sales, you reach out to your sales department, right? So the figure will be given to us by the sales, the marketing department.
You will have to provide the data.
Okay, all right.
Yes.
So basically, is it safe to say that the person in charge of the sales budget is the marketing or sales team? They are the one in charge of the sales budgets.
They are the one in charge because they are the one that they are going to give us their forecasts or data, like a projection you are getting from them. So the data is coming actually from the marketing department. Okay. So because they are the one in charge, they are the one that deal with the customers, they can easily predict.
That's fine. Your screen is blank.
Yes, I'm with you. I will share now.
Okay.
I'm trying to share the
Okay. You can just put it in presentation mode.
Okay. So, based on the information from the marketing department, they said they will be able to sell 15,000 units in 2023 at a selling price of 200 naira per unit. I think that was their forecast. So they said the sales unit is going to be 15,000 units, while the selling price will be 200 naira per unit. So we now go back to our Excel sheet. So let's go back to, let's name this product. The product we are producing, they are producing is called HDP, high density polyethylene. That is the name of the product. So based on the forecast from the marketing department, they said they will be able to sell 15,000 units of the product. So we come to our budget total column. So we have to insert it, 15,000 units. That's 15,000 units at what price? That's 200 naira per unit.
Yeah.
So that's 200 per unit. So we have the data already. So the formula is to get your sales revenue. So you multiply your sales budget, your sales volume by your selling price, which is S1. I think that's S10 multiplied by S15. That will give you your sales revenue.
Okay.
For that particular product. So to get your total revenue for 2023, so you just add all your products. If you have more than a product, so you add all the sales revenue.
Okay.
Product 1, product 2, and product 3 sales revenue. You add it together to get your sales revenue. So our sales revenue for 2023 is 3,000. I think this is 3 million. That's 3 million. Total sales revenue is 3 million. Let me increase the font. So the total sales revenue is 3 million. I think that this is just a simple way of calculating your sales revenue.
Okay.
I think we have actually calculated our total revenue for that particular period. So we can now move to the next line, which is the production budget. You can see that to calculate our sales budget, the sales revenue is very simple. Once you know your selling price and you know your sales volume, you can easily calculate your total revenue for a particular period by multiplying your sales volume by your selling price.
Okay.
So the next thing is to go to our production budget. So from our production budget, let's go back to our So this is our material budget. So we are told that information and data gathered from the production manager revealed that to make one share. No, we are dealing with production budgets rather.
Okay.
So the following are the factors to be considered when you are preparing your production budget. So you have to know the sales volume for a particular period, which was what we were told by the marketing department.
Exactly.
That we'll be able to sell 15,000 units for 2023. So you also have to know your desired opening stock.
Okay.
At the beginning of the year, because for you to determine your production, you have to know the number of units of your finished goods that you have in stock. So you also have to know the closing stock that you want at the end of the year. Because for a manufacturing company, it's not as if you want to sell all your products. What if you don't have raw materials to produce the following year? So you have to have an optimal level of inventory at all times. which is I think it's called the EOQ. I think that's EOQ. Once you know your EOQ, you'll be able to determine your optimal level of inventory, the opening inventory that you want, and the closing inventory, and you plan based on that.
Okay.
So the company always keeps 50% of its expected sales as the closing stock for the current year. So the question says the company always keeps 50% of its expected sales. So the expected sales for
50% of
is
okay. Is it 15,000 units?
Expected sales is 15,000.
Yeah.
So the closing stock will be 50%, 0.5 of
15,000.
15,000. That will be the
7.5
desired closing stock.
Yeah.
So why the opening stock for the current year is always the closing stock of the previous year. So now we are preparing a budget for 2023. So the opening stock, the closing stock of 2022 will be the opening stock for 2023. So automatically, our closing stock of 5,000 units for 2022 will be our opening stock for 2023. So our desired opening stock is 5,000 units, while our closing stock for 2023 will be 50% of 15,000, which is 7,500.
Okay.
So let's go back to our Excel.
All right.
So let me unhide the items.
Okay, you can see your screen now.
Okay, you can see. Okay, these are production budgets. So the first item we have here is the volume in units. That is the volume of your finished goods. So our finished goods here is our HDP. And we're told that the volume of our production for 2023 is going to be 15,000 units.
Yeah.
So we insert 15,000 units. So that's 15,000 units.
Yeah.
What is our desired closing stock?
5,075.
That's 7.5. That's 0.5 multiplied by
15,000.
15,000. That's 7,500 units. So we need to sum up our sales volume and our desired closing stock. So that will be sales volume plus desired closing stock. So we have 22,500 units. So we now deduct our desired closing stock. So our desired closing stock is 5,000 units. So this is 5,000. So the formula will now be 22,500. That is S32 minus S33. That will give us our total production in units for the whole year. So we are trying to produce 17,500 units for a whole year, simply because we have an opening stock and we have a desired closing stock at the end of the year. Actually, we want to sell 15,000 units, but we already have 5,000 units in stock.
And then we want to close with 7.5.
And we want a closing stock of 50% of desired sales. That was how we arrived at our 17,500 units.
Yeah, so
which is our expected production for the period. It means from January to December, we'll be producing 17,500 units of HDP. So we can now move to the material budget. So for us to prepare our material budget, we need information from the production budget.
Okay.
So since we are producing 17,500 units, we have to know the unit of raw material that is required to produce each unit of the particular product. It is only when we know the required material that we can easily predict the material requirements and the total material costs that we are going to incur for that particular period. So let's go back to our slide.
But in a real life situation, who provides this information on what quantity of what we would need to produce 1 unit of our products?
Yes.
Where do we get that information from? What departments are we supposed to liaise with to get that information?
That would be from the production department.
Okay.
Because they are the one in charge of producing that particular product. So and they know the unit of raw material that is required to produce the unit of that particular product.
Okay.
Let's assume you have been producing a particular product for 5 years, 6 years. You should be able to tell them you need so unit of raw material.
Yeah, I tell.
A unit of that particular product. You can easily get it from the production department.
No problem.
So we are now moving to our material budget. So information and data gathered from the production manager reviewed that. So it was the production manager that provided this information. You can see how individual managers are contributing to the whole budgeting process.
Yeah, exactly.
So they give their inputs. So the production manager said to make 1 chair, they will require 25 kg of raw material. So they will require 25 kg. It means to produce 1 chair, they will be making use of 25 kg of AD. And also, they said the procurement unit, after making RFQ, that is request for quotation, they sent the request for quotation to their suppliers. And the supplier said each unit of HDP, which is the raw material, will cost 2 naira per kg. That is the cost per unit of the raw material. So I think these are the information we need for the material budget here. We need the material per kg that is required and the cost of material per kg. So we'll be using 25 kg to produce 1 chair, and the cost of 1 kg of the raw material is 2 naira per unit. So we can easily determine our material requirements as well as the material costs that is required to produce that particular product.
Exactly. Your screen is not showing.
It will show now.
Okay.
So we are now moving to our material budget.
Okay.
So we have material budget. We have the production volume in units. How many units of product are we trying to produce now?
17.5.
17.5. So we can easily say equals to production in units. I said equals to S35, which is the total production in units for the whole year. So that's 17,500. That is the production volume. We want to produce 17,500 chairs for the whole year. So the next line is the standard direct material per kg per unit. So to produce 17,500 kg of chairs, we'll be needing 25 kg of raw materials.
Yeah.
To produce a chair.
Yeah.
So we can easily say this is 25 kg. So the formula is already there. You can easily say your production volume multiply by your standard direct material per unit, which is 25 kg. So we now have the total material required, which is 437,500 kg
yeah,
of raw materials. This is the material requirement. for 17,500 chairs.
Okay.
So, like we did in our production budget, we also need to keep a particular amount of raw materials for production as our closing raw material and our opening raw material.
Okay.
So, what is our desired closing material? What will be our desired closing material? So, our desired closing material will be what is the unit of closing stock that we want to achieve at the end of the year. We go back to our production budget. Desired closing stock is how much?
7,500.
I think that's 7,500 units. That is our desired closing stock of finished goods. So for us to achieve this particular level, we need to have a closing raw material.
I was thinking that this 17,500 that we're using already factored in that closing raw material.
No, that is only what we are going to produce. That is only what we are going to produce.
But in arriving at that 17,500, we already factored in our opening and closing.
But we still need to consider our closing raw materials too.
Okay.
Because we are assuming that we have produced this 17,500 units. So it's now a finished goods. It's not a raw material again.
Okay.
So it's a finished goods now. It's not a raw material.
Okay.
So this is what we are going to do. So to have a closing raw material of 7,500 units, let's assume we'll be using 7,500 units. Multiply by, to produce 7,500, we need 25 kg of raw material, which is this. So our desired closing raw material is 187,500.
Yeah.
So like we did, we have to deduct our closing raw material from our total raw material required.
Okay.
So that will be total material. We add it to our desired closing material, which will be, that will be S41 plus S42. Total material plus desired closing material. So that will be 625,000 kg of raw material. So what is now our desired opening inventory? So our desired opening inventory of raw material, we can also base that on, it's just like an estimate. We are making an assumption. In a real life situation, we have a particular data. So we are just using an assumption. So our desired opening inventory will now be desired opening stock of finished goods multiplied by raw material requirements per unit, which is 25 kg. So that will give us 125,000 units of raw material. So the final thing is that we have to know the amount of raw material we need to buy at the end of the day for the whole year. So to get that, we have to deduct our desired opening inventory from this value. So that will be 625,000 minus 125,000. So our expected raw material purchase is 500,000 units of HDP. So we are going to be buying 500 kg of raw materials. At what rate per kg?
220.
Based on the information, we are told that it is 2 naira per kg. That is the cost of 1 kg of the raw material. So that will be 2. So expected purchase price per kg in naira that will be 2 naira per kg. That will be 2 naira. So this is the formula sheet. The expected raw material purchase in units multiplied by the purchase price per kg. This is giving us our total cost of raw material purchase. So we are going to be buying raw material worth 1 million for that particular year. That will be our total cost of raw material purchase for that particular year. So now we have our total revenue, which is 3 million. We have our total production in units, 17.5, and we also have our total raw material cost, which is 1 million. So we still need to get our direct labor cost by preparing the direct labor budget. So the next thing is to prepare our direct labor budget. So we go back to the information we're given. So information and data gathered from the production manager revealed that to make 1 unit of chair, it will require 25 kg of raw material and 5 hours of direct labor. So we are going to be using 5 direct labor hours to produce 1 unit of the product. 5 hours to produce equals 1 unit of chair. So we also told that the Human Resource Department has estimated that the cost of 1 labor hour is 15 naira per hour. You can see where the different departments are giving their input. First, it was the production department. Now, the Human Resource Department. So we have that's 15 naira per hour. So for every hour worked, a labor will be paid 15 naira. I think that's the data we need from that.
Okay. Your screen is blank.
Okay. We're now going to the direct labor budget.
Okay.
So direct labor budget. So let me unhide. So this is direct labor budget. So for you to get your direct labor budget, you have to know the production volume. And from the sales budget, we're told that the production budget, from the material budget and the direct production budget, we're told that we are going to produce 17,500 units of that particular product in 2023. So meaning that we just say our production volume equals to production volume in the material budget, which is 17,500. What is the standard direct labor per unit given? We're told that the standard direct labor per unit is 5 hours.
Okay.
So we'll be using 5 hours to produce 1 unit of chair. So we now come here, we insert 5 hours. That will be 5. So our total direct labor hour required in hours will now be our production volume multiplied by the standard direct labor hour per unit. which is 17,500 multiplied by standard direct hour, which is 5 hours. So we'll be using 87,500 hours in the whole year to produce 17,500 units of that particular product.
Okay.
So this will be in hours. So we now need to know the standard direct labor hour rate per unit.
Yeah.
The direct labor hour per unit. The direct labor hour per unit is 15 naira. So we come here, we insert it, 15 naira. So we can easily see our total direct labor hour in monetary terms, which is the total direct labor hour required multiplied by the standard direct labor hour rate per unit, which is 15 naira. So, meaning that at the end of the year, the expected direct labor hour cost is 1,312,500.
Okay.
That is the
Can you see him? Hello, can you hear me?
production in units for the whole year is 17,500 units. So we have our material budget where we are told that total cost of raw material purchase will be 1 million naira. While the direct labor budget is 1,312,500, which is the total direct labor cost for that year. We can now see the link between the principal budget factor and the functional budget. You can see that there was a link between the sales budget, production budget, material budget, labor budget, and production budget.
So the sales budget is like the foundation for everything.
For the production budget, you can't prepare the material requirements.
Yeah. Okay.
I'm with you.
So I said the sales budget is the foundation upon which every other thing. Okay, sorry. Can you hear me now? Is it better?
I'm with you.
Is it better now?
Hello.
Yeah, can you hear me? Okay.
Hello, can you hear me?
Yes, I can hear you. Okay. So I said that the sales budget is the foundation upon which every other thing is prepared.
Yes, I'm with you now. Yes, it is the foundation upon which all other budgets were prepared.
Okay, perfect.
So then I think the next thing on our slide, let me check the next thing on our slide.
We need to hurry up. We are past.
It soon be true.
Okay.
It soon be true. Can you see my screen?
Yes, I can.
I think the next thing is the cash budget.
Yes.
So the cash budget is basically about the inflow and the outflow. So we can also prepare our cash budget from the data in other functional budgets like the sales budget, material budget, and labor budget. So based on the information we're given, we are told that the company in the past has always collected 80% of their current year sales revenue. Same year sales were made. If they make sales in 2023, they will be able to collect 80% of that sales revenue in 2023. While they remain 20% the following year. The following year. Also, 100% of total material purchase and labor are payable in the year they were incurred. So all the expenses incurred on purchasing raw material and paying employees are going to be paid in the current year, which is 2023, 100%.
Okay.
So we can use this data to prepare our cash budget. So we can easily use this to prepare our cash budget. Let's go to our cash budget. Okay. These are our cash budget. That's the next sheet. Can you see my slide?
Let me see.
Can you see my screen?
Yes, I can. Yes.
Okay. So this is basically the template I designed for the cash budget.
Okay.
So we're looking at our collections, our pay and our payables, as well as our salaries.
Okay.
So from the information we are given, we are told that we have collections and we have revenue. So what will be our opening balance in terms of collection for 2023? From the information we are given, we are told that 20% of the revenue is collectible in the following year.
Yeah.
Meaning that all the sales of 2022, 80% was collected in 2022, while the remaining 20% is collectible in 2023.
Yeah.
So since we have that information, we can easily say the opening balance will be 0.2%, which is the revenue we are expected to collect in 2023 from 2022.
Yes, 20%.
Yeah. That will be 20% of previous year sales. But we don't have data. Do we have data relating to our previous year sales?
We would have to check.
Do we have data regarding that? I think we have.
Okay.
Yeah. So let's go back to our production budget, sales budget. These are the information. The marketing and sales team said their assumption were based on the fact that the actual sales in 2022 was 10,000 units at 150 naira per unit. Okay, so so we can easily get our sales revenue for that period. So for 2022, we were able to sell 10,000 units at 150 naira per unit.
Yes.
So that's the data we need. So let's go back to our cash budget. So you can easily come here and say equals to 150, that's 10,000 units multiplied by 150 multiplied by that 0.2, that's 20%.
Yes, exactly.
0.2. It means we are expected to collect how much? 300,000.
Yeah.
So we assume that will be our opening balance from previous year. That's 300,000. So the next thing, current year sales revenue collectible. So we are told that we'll be able to collect 80% in the current year for the current year sales. So meaning that you can say equals to 0.8 multiplied by, let's go to our operating budget. We check our sales revenue. Total sales revenue is 3 million. So that's 3 million. So that's 8%, 80% of total sales revenue in 2023. That's 2.4 million. That is the revenue collectible in the current year. So our total inflow will now be the addition of the opening balance plus the current year sales revenue.
Okay.
So this
plus 2.2.
this.
Okay. Let's not forget to delete this 300,000 calculation so it doesn't confuse people.
That's 2.7 million.
Okay.
Hello?
Yeah, I said let's remove that 300,000. Yeah, so it doesn't confuse people. Okay.
Okay. So that's 2 points. So total inflow will be 2.7 million. So we now move to our payables. Are we going to have any opening balance for our payables?
You said the payables are settled in the year in which they are.
Since they are settled in, so they will not be opening payables.
Yeah.
So this will be nil. That will be nil. So the current year raw material purchase, we have to go back to our operating budget. How much was spent on buying raw materials? We go to our material budget. That is 500,000. That is expected raw material purchase. Total cost of raw material is 1 million naira. Let's go back to our cash budget. So we are saying that this is equals to 1 million naira. So that is the current year raw material purchase. That is the cost. So next we go to current year direct labor costs equals to, let's go to our direct labor budget. So the cost is 1.3 million. So we now have our payables. No opening payables. We have the current year raw material purchase. We have the current year direct labor costs, which gives us our total outflow. What was paid to to suppliers and to our employees. So the total outflow will now be 1 million plus 1.3 million. This is the total outflow. So we now need to get our net cash flow from operation, which will be our inflow less our outflow. So it will show whether we have a favorable cash flow or not. So that will now be equals to total inflow 2.7 less total outflow. So we have 387,500, which is positive. So it shows that we have a net cash flow that is positive.
Okay.
So we are expected to have this cash flow at the end of the year. This cash in our book at the end of the year. Rather than having an overdraft or something like that.
Yeah.
We having a positive cash flow. So this also shows the link between all those budgets. You can also see that all other budgets are also linked to the cash budget.
Yeah, so there's something that I noticed about
so final will be.
No, go ahead.
Okay.
No, you wanted to say something?
Okay, no, go ahead. I'm with you.
I think okay. I'm with you. So I said that one thing that I noticed about all of this budget that we've done so far is like everything is stopping at the gross profit level. We're looking at our sales and then our cost of sales, which is like the cost of production, right? No, is it that you guys?
You're basically looking at the cost of production.
Yes. So
we didn't consider fixed overhead and other overheads.
Yes, like other expenses like advertising.
Yes, that will actually be considered in the master budget.
Okay.
Like an income statement.
Sorry, I was moving too fast. Thank you.
No, you're not moving too fast. You asked important questions. So now I think we have our cash budget now. We have our production budget, the sales budget, we have the direct labor budget, and we have the material budget. So let's just, I think we can use 5 minutes to calculate the variance. So let's go back to, let me untype.
Okay.
So you can see this. Can you see my screen?
Let me see. Yes, I can.
So this is 2023. budget total. So we can see that we are told that the sales volume in 2023 is 15,000 units, while the sales price was 200 naira, and the total sales revenue is 3 million.
Yeah.
So we have to see, so for us to calculate our variance, we have to know the actual performance of an organization for that particular period.
Okay.
Because that is what we are going to use to calculate our variance.
Okay.
So without, we can't calculate our variance. So information about the actual performance of the organization for year 2023.
Okay.
So let's go to the next slide. Okay, this is it. Total sales units. So this is the actual performance of the organization. Total sales units in 2023 was 17,000 units. Sales price was 280 naira per unit. Total production was 18,000 units. Direct material price per unit. Direct material per unit is now 30 kg.
Okay.
While the direct labor cost per unit was 20 naira. So we are just going to use this for our variance.
Okay.
So there's a column for variance actual versus budget. So you can make it in percentage or in monetary terms. So depending on what you want. So for the first line, we have the volume in units for sales. We're told that the actual sales volume was 17,000 units. So we insert our 17,000 units. This 17,000. I'm coming.
Okay.
General. Okay. That's 17,000 units. So that's 17,000 units. Okay. Can you see my screen?
Yeah, I can.
So that's 17,000 units. So I think I have to open a slide. Okay. So the 17,000 units will be in this actual 2023 total. That will be 17,000 units. So in percentage, for us to calculate our percentage change, so we say equals to, you can use if error formula. If error. So we can say 17,000 divided by 15,000 minus 1, comma, not applicable.
Okay.
Okay, I think that's 0.13. Let me put it in percentage. I think that's 13%.
Yeah.
Variance. You can easily see the variance. It is 13%. It means that it increased from 15,000 to 17,000 units, which is a 30% variance, which is a positive variance. Actually, we planned on selling 15,000 units, but at the end of the day, we sold 17,000 units.
Okay.
So in absolute terms, we can easily say equals to 17,000 units minus 15,000 units. So that's 2,000 units favorable variance. You can put F. So variance can either be favorable or adverse.
Okay.
So this is a positive variance. Also, we are told that the selling price, the actual selling price was 280 naira per unit. So we can insert that here, 280. So we can bring our formula again. That is 40% increase in the selling price. We projected that the selling price will be 200 naira, but at the end of the day, we were able to sell for 280 per unit. So in monetary terms, it will also be 280 minus 200, which is also a favorable variance.
Yeah.
So let's now go to the revenue. The revenue also, you can see, we can calculate for change in revenue too, using the same formula. Just copy and paste. That's 59% increase in our revenue. Also, just copy from here, paste. So revenue increased by 1,760,000. That is the increase in revenue.
Okay.
Which is also a favorable
variance.
So, although we can have an adverse variance, let's assume the price here is the selling price here is 150. Let's check. You can see we have a negative 25%.
Yeah.
So it is not always positive. It can be negative too.
Yeah.
So let's change it back to 280. So you can easily see. So I think we still have the same thing here, since we only have one product.
Yeah.
So you can see we are comparing our actual performance with our budgeted activity. So we're able to get the variance, whether it is favorable or adverse, which is one of the major importance of budgeting, which is performance evaluation. We use variance analysis to look at the actual performance with the budgeted performance. We can also do that for production budgets, the material budgets. Like the material budget, now we are told that they actually used 30 kg per unit instead of the budget 25. Is it going to be an adverse or favorable variance?
Adverse variance, because we use more resource. Yeah.
It means that they are using more resource. So all these need to be investigated. What is the cause of this? Is it that the machine that was used is getting older and older, or the laborers they are no more efficient, or we are losing our key employees? So those are the things that they need to investigate when there are variances. So or do we need to buy a new plant, a new machinery to improve our production efficiency? So those are the important questions. So if we don't have something like a budget, we won't be having anything to compare our performance with. We just be making production.
Yeah.
And if you don't have a plan, it means you are planning to fail. According to Benjamin Franklin, I think that was what he said.
Yeah.
Fails to plan is planning to fail. So basically, I think these are the most important things that we need to know when it comes to budgeting.
Okay.
So you'll be able to identify a variance. So once you know your variance, you will know the necessary action to take in order to solve that problem.
Thank you so much, Ridwan. Like, this has been, when you were going through the tutorials, it took me back to the days of cost accounting, where everything were being simplified. The good thing about this tutorial is the fact that I love how simplified it was. I mean, like I said, we cannot really consider in different companies and their different organogram or how things are done in their company. But at least once you know the basic like this, you can tailor it to suit how things are being done in your company. Because for instance, I noticed you're using marketing. There's a company that they have sales department and they have marketing department. Do you understand? But learning this basic is actually very, very important. And truth be told, this was really, really simplified. I mean, I don't work in the manufacturing sector anymore, but I feel like right now, if anybody contacts me to help them with budgeting, like, it will be a walk in the park for me. Thank you so much for honoring our invite. Thank you so much. It's been really interesting hearing you tutor us and teach us all of this interesting stuff. As our usual culture, do you have any last word for us before we see you again?
Actually, thank you so much for bringing me to this session.
Okay.
Thank you for impacting people, because all these things, it goes a long way. So like when I started using LinkedIn, I remember I think I passed through you when I was trying to use LinkedIn. I think there was even a day you called. I think there was a day you called me.
Yes.
And you critiqued me.
Yeah.
And I think I remember. I can still remember. I think there was a post I made. I think probably the following week.
Yeah.
I think that post had like 49 shares. I was like, see, when people criticize you sometimes, I mean, I don't even see it as criticism. Critique, I see it as a critique.
Yeah.
You get the negative, you also see you only look at the positive angle from it. So, as a professional, we have to improve from time to time.
Definitely.
We learn, we unlearn.
Exactly.
And we apply our skills from time to time. It's as if we don't have the knowledge. So we have to find a way to apply our knowledge. So as an accountant and other professionals, we have to keep learning from time to time.
Exactly.
Look for people that they have experience more than us in our field. We learn from them. We also serve as mentor to upcoming people within the field.
Exactly.
I think that is the most important thing. Because if we are learning from people, people are not able to learn from us, it means we are just like, what would I call it? There's this relationship in biology. We are just like a parasite.
Exactly. Is it symbiosis?
We are just like a parasite.
Yeah.
We benefit from others while we are not allowing others to benefit from us. So let's try and create a relationship. I think they call it symbiosis in biology, in which we benefit from others. We should allow others to benefit from us. Definitely. So let's not be a parasite. Let's impact people, and let's also learn from people. Thank you for bringing me here today.
Thank you so much, Ridwan.
Thank you so much.
I really cannot thank you enough. And on behalf of everybody in the community, and whoever is going to pick up this material some years later, I'm just coming to say thank you. Thank you so much. God bless you. God increases you on all sides. It's so good to have you on the call.
And happy birthday in advance again.
Thank you. Thank you so much. Enjoy the rest of your